You must have like clicked 4 times probably on the button join, huh?
Yes, I did because my computer doesn't is not slow at all. So I was like, why is it not working? Let me try it again, and
Double click, yeah.
that's how we
That's
got it.
what that's what happened.
So now we're recording. After some difficulties we have a couple of days ago. So here we go. How's it going, buddy?
Yeah, listen, it's going well. The weather doesn't help here much in Luxembourg, but it's going well otherwise, huh?
Exactly the opposite in Cyprus. It's 35 degrees out.
35 degrees out, and how
Yeah.
about inside in your heart?
You know what? It takes a couple of weeks of hot weather for the house inside to start getting warm. I have to
Yeah,
start putting the air conditioning. So far, so good.
but I meant inside your heart,
Oh,
inside
my
of you.
heart. Oh, you know what? I like the warm weather. I don't like hot weather. Anything above 38, 39, I just can't take it. But between 30 and 35, 36, I'm all for it.
For me,
I'm
the best is the extreme temperatures, the
Yeah.
lowest possible or the highest possible, because this impacts directly my portfolio return. Because I'm invested in energy, and we use more energy at both extremes.
In the ex so in the extremes, the heating the heating goes the heating expenditure of people goes up, so it's good for energy. In the other extreme is the air conditioning and traveling
Absolutely,
and all that. So you need the extremes for energy.
absolutely.
In the middle, you still need energy, but it's not the way we would like it to be as investors.
Yeah, yeah, definitely. I mean, the middle, it's not great. As an energy investor, it's not great in the middle
Yeah.
because if the temperature is really middle and we
Mhm.
have a lot of daylight during the day, we don't
Mhm.
need to use electricity much. I know that my dividend yield will go down.
Yeah. Mine as well. Mine as well.
But you're not very much an energy guy. You're more like a
I
tech.
only have one position, which is probably 5 or 6% of the portfolio.
The ExxonMobil, yeah.
ExxonMobil, yeah. It was much higher than that, but other things appreciated. And I got into that interesting fact. I got into that when it was really hated. Do you remember 20 end of 2020, beginning of 2021, oil went negative for 3 days? Do you remember that?
And with the price per barrel of $30 for a while, yeah, that
Yeah.
they were selling it for for cheaper than they were
They were
producing,
they were
and
paying you
they were paying you to pick up the
to
barrels
pick up the
because they
oil
didn't
because they
have
didn't
enough
have any storage.
storage.
Yeah. So
Mm.
during those days, listen, that was listen, you can read all the books you want, you can be prepared. That was once in a lifetime thing. That didn't happen, at least in our lifetime. So at that time, what do? You say, okay, they don't have any room to storage, so they have to pay you to get it off their hands. ExxonMobil was, if I'm not mistaken, $15 or $20 a share. Okay, and I bought. And my mistake was not buying,
Enough.
not buying more.
I'll buy more.
And then from 15, 20, now it's at 100, 120.
But when you think about it,
Yeah,
the year 2020 was really, really insane.
it
You
was.
had some crazy conditions going on. Everyone
Mm-hmm.
was quarantined, right?
Mm-hmm.
Everyone was at home with living in the metaverse.
Mm-hmm.
You had some valuations of some crypto coins like Shiba
Mm-hmm.
higher than really proper companies, right?
Mm-hmm.
That actually
Yep.
produce stuff and produce cash. And you had oil at negative prices where they were paying you to to pick up the
Mm-hmm.
oil that you can, and interest rates that were negative, where the banks were basically paying you to take the money from them.
Yes. Yes.
It's insane how much things changed in 3 years, actually. In three
Yeah.
years, everything just changed. Energy now, energy prices are insane. Like you
Mm-hmm.
need to beg the producers to buy the energy from them. You
Mm-hmm.
need to beg the banks to get a loan. at
Yes.
an interest of 4 or 5. In the US, is 7, 8% mortgage rate.
Mm-hmm.
No one's quarantined anymore, so it's very difficult to book any proper vacation anywhere.
Mm-hmm. Yes.
Everywhere is crowded. Every touristic area you go to is crowded. Even in March, I was in the Canary Islands just last month. It was full of British people. It was so crowded, insane, and very expensive. It's completely the opposite world in just 3 years.
And what's funny is that if I told you just 3 years ago that we're not going to have a major crisis in the economy, I'm talking about the US economy, we're not going to have a major crisis in the economy, and this you will be in the position we are now with technology skyrocketing and oil and everything, you say that's not going to happen. That's not going to happen. But that's why it's so difficult to do this thing, the investing. You can hear the forecast, but they're not accurate. They're going to get it maybe in the ballpark in the next 2, 3, 6 months. You can't tell what's going to happen in 2, 3, 4 years from now.
But I tell you something, 3 years from now, we will talk again and we will be like 2024. Do you
Mhm.
remember in
Yeah,
2024 how we were
yeah, for sure.
discussing this and that? And it will be a complete different paradigm. Maybe it's not even going to be you and me speaking. Maybe it will be some AI representations of both of us, right? Speaking to each other 3 years from now, right?
I
And we'll just be
I pref-
watching.
I I prefer this version of you though.
Thank you. The pleasure is shared. And that's what investing is about, is
Yeah,
that you really don't know what's going to happen 3 years from
yeah.
now. You can say, yeah, Bitcoin halving is this year, so next year for sure BTC will be at
Mhm.
130K. I mean, everyone's expecting that. Everyone is expecting next year Fed rates 3%,
Mhm.
inflation under 2. You can have all the certainties in the world that you want, but none of them will go according to plan. There will never be one forecast that will be really accurate.
Yeah.
And as an investor, you have to really prepare for all possible scenarios.
All
So your
possible.
portfolio needs to be prepared for everything. You can believe in AI if you want, but you should not have your whole portfolio in AI. You need to have some treasuries, you need to have some energy exposure, you need to have really a lot of diversification
Mhm.
over the long term. You need to be diversified because you don't know how in 3 years it's going to be. You remember how it was 3 years ago? You remember probably 2008, 2009.
Mhm.
um it was also complete different paradigm,
It was,
and it
yeah.
changes very quickly.
The economy was the economy back then was way different. The companies that they were top of the food chain back then, and not even in the top 20 today.
Yeah, look. If we go even a bit earlier, the dot-com bubble. Look,
Yeah,
Cisco. Cisco was the Nvidia at that time. Look where it is now. You
yeah,
know.
you could make the case Cisco was the Nvidia at the time, yes.
Uh, so look where it is now. I'm not saying Nvidia will be the new Cisco. We just don't know. So don't go all in Nvidia. Also have
The thing
some.
with the thing with Nvidia will also, if I told you a year ago that Nvidia that has revenue of $60 billion a year, okay, is gonna be around the same market cap as Apple that has $250 billion of revenue, you would say you're crazy. But here we are. Here we are. And I bought Nvidia when it was 130, 100 and no, maybe it was 200 to 20. And before you know it, it's $900 stock.
Yeah, yeah, and that's what's really insane, I think, about the stock market, and that's why you have to be diversified, but
Yes.
also you have to take those risks like you
Mm-hmm.
took with Nvidia. Because if you
Mm-hmm.
were a boring investor like me, you would just buy Apple and stay with Apple because you know that the revenues are kind of stable of Apple.
Mm-hmm.
And actually, it's the big problem now of Apple is the revenues are too stable.
Yes.
What the shareholders want to see is high growth, but if you have high growth, you also have high risk at the same time. Huh?
The thing with Apple is, I mean, they own half the market in producing and selling cell phones, okay? So how much more they're gonna get? The thing with the car, with the electric vehicle, that didn't work out, and they shut it down. Today, I read on Bloomberg that a team of engineers, they looking into creating robots for for your house, to have it like as your mate. So they're looking into that. They're looking to get into a new market. They need to get into a new market. They have the Apple Store, the online apps. They have that. They have the phones. They have the computers.
Hmm. Hmm.
They have the gadgets, the earpads and all that, the iPads. They have all that. So they have to get into a new market. So investors can say, you know what, I can see this company going from 2.6 trillion to 4 trillion. And even though they're buying so much of their own stock back every year,
Hmm.
do a huge amount of share buybacks, but it's a mature company, It's like, and it's so large, they have to figure something out. And then they're in the middle of US China trade, trade war, or whatever that is, geopolitics. They're in the middle of that. That's that's what happens when you're too big.
Yeah. Apple also tried to go in the banking, right? With
With with
they
Goldman,
tried. Sorry.
with Goldman Sachs.
I mean, they tried to have their own basically app, right, with a lot
Mhm.
of banking functions there where people could deposit their cash.
Yes,
What happened to that? There were a lot of beta users that were really interested to use, but I think at least here in Europe is not available, not to us.
it was a collaboration with Goldman Sachs
Okay.
to do like a joint venture of getting into banking.
Hmm.
I think they stopped it. I
Yeah.
think yeah, I think that they look into it. And you know what? There are so many ventures like I was reading this morning, Amazon. Do you remember Amazon going into having stores without people walking into the stores? You're walking in and you scan yourself and you scan your ID and credit card and you just take whatever you like and you just leave the store and it's going to charge you
No,
uh,
I don't
automatically.
remember that. No, no, I don't
Remember
remember
that?
that.
So they
But
started.
I do know that they tried a lot of different things.
Yes, yes, they try a lot of things, and most of them don't work. But the one
Hmm.
thing that's gonna work, it's gonna make them a fortune. So that thing with the store, I was reading this morning that they're gonna stop doing that now. They're gonna stop
Hmm.
that venture. It's not working. They gave it a try. It was a good idea during the pandemic that you don't want to speak to anybody. You don't want anybody to touch your stuff. It was a good idea at the time, but 3 years later,
Hmm.
and then the whole thing changes.
Hmm. But do you know the story of Samsung?
No.
It reminds me a little bit what you just said about Amazon. The story of Samsung, actually, it was a big Korean conglomerate, but they
Mm-hmm.
were not focused on electronics like now. They were actually in the sector of food processing, of groceries,
Mm-hmm.
of textile. That
Okay.
was their main sources of revenue. And then, they kept trying different things over time, right? And they started selling some hardware, right? As part of their food sales. They started selling some hardware. And then little by little, they actually went into the tech sector to become the huge electronics manufacturer that we know now. And this shows that companies that try, so for example, Apple, we say that they have half of the phone producing market, right? And there's no more growth ahead. That's true. But I think that companies like that we see that they keep trying to tap into new sources of revenue. Um, in my opinion, they're promising because, in my opinion, with the level of capital they have and with the brains that they have,
Mhm.
I think they will be able to find those new sources of revenue to grow. And
Yeah.
it's not necessarily going to be in the phone sector anymore. It might be in something quite different. So they tried with the car, they tried with the banking. We don't. It's not yet a failure in banking. I think they're still trying to see. Uh, but maybe they will grow in that sphere. Maybe they will find something else. Maybe it will be with the robots, like you mentioned. And I think it's important when you select a company to keep for decades.
Mm-hmm.
It is very rare that a company will stay leading its sector where it originally was leading,
Mm-hmm.
right? So you have to choose a company based on its potential and its capacity to expand in other sectors and to
Yes.
reconvert and to reinvent itself.
Yes.
And this Apple is definitely able to reinvent itself as a
Oh, for
company.
sure. Yeah. Apple is, I believe, is the third or the fourth company in spending in R&D, in research
Mhm.
and development. So they spend a lot of money. They're trying to find what is the next thing. What is the next thing? And don't get me wrong, the thing with the car that they just stopped trying is not that they couldn't make a car. They saw from Tesla and from other companies making cars that it's a low margin it's a low margin business. So why bother? Let
Mhm.
Tesla do the cars and we're going to do something else. That was the
Mhm.
thinking behind it. It wasn't that they were incapable of creating an awesome
Yeah,
car.
yeah,
I'm
yeah.
sure they were, and I'm sure they could buy Rivian tomorrow or Ford or both
Mhm.
and put them
Mhm.
together. And they're gonna
Yeah.
have more money. I think they're sitting on $70 billion, something like that. So they have the capital to do a lot of things. But
Yeah,
they
for
try
sure.
to choose, yeah, because and you know
For
what?
sure. But I would not enter Apple despite saying all the positives that I just said,
Mhm,
because I want to at least have a glimpse on what's going to be the next big thing. So
mhm,
at least have a sense. And right now, I don't see any innovative idea for now. So yes, it will be a bit too late once once it's publicly known that they're into the
mhm,
next big thing, the stock will already soar. But being a conservative investor, I prefer to wait to have a glimpse, at least, of it,
mhm.
rather than be now stuck with this stock for the next maybe 5 years. Maybe next 5 years we will remain flat on this stock. We don't know
Quite,
when will be the
quite
next
possible,
big
yeah.
thing, And this is why Nvidia soared as well. It's all due to AI that it started
Mhm.
soaring last year. It didn't become a fantastic company last year.
No.
It's just that investors realized that Nvidia was into the next big thing. They
Mhm,
realized it last year, and now the stock price is adjusting to a much higher level now that
mhm.
we know that it's into the next big thing. But this is what I want to see in Apple. Is I want to have at least a glimpse of that something new is going to happen before entering the trade.
The thing with Apple, you don't own Apple? You're not into it?
Me? No,
Yeah.
no, no, no. I don't.
No.
I don't know.
If it, I think now the stock is
My full
go
disclosure, my wife does though.
on.
She has the stock.
Okay, if so, the stock now is 169,
70, yeah.
170. Okay,
Yeah, around that.
I'm the only investor known to anybody that never owned Apple, never bought it, never owned it, never. If the stock goes down into 100 and in the low 150s, I'm buying.
Hmm.
I'm buying.
Hmm.
But I don't have to buy it because I have other things in my portfolio. I have other tech stocks. So, and I'm not holding a lot of cash, so I have to make a move. You know what I mean?
You
You
have
have,
7% cash
yeah,
is enough for just one position, basically.
maybe two,
One, two,
maybe
maybe
two,
two.
one or two. And you're the same way. You barely hold any cash. So we are not
Yeah.
we don't have a lot of pressure to make some moves, to make something happen. We get appreciation for our positions. Other people that they hold 30, 40, 50% in cash, okay,
Mm.
and they have to make some moves. And then you try to pick the timing. And when you try to pick the timing is when things go wrong.
Hmm. Yeah. Yeah, yeah. I was reading yesterday a chapter of this book. Yeah, I'll show it. Maybe you know it. I don't know. It's blurry, right?
It's blurry,
Cannot
yeah.
see it.
No, I don't see it. Nope.
Okay. It's just called Just Keep Buying
Yeah.
from Nick Maggiulli. Just Keep
Yeah.
Buying. And I was reading a chapter. It's a good book to read. Especially if you're just starting, I think in stock market, it's good to read. It's not too technical. There are a lot of practical tips. And I just finished a chapter yesterday where it said that DCA beats
Mm-hmm.
God, actually. So God knows everything, knows
Mm-hmm.
how the stock market will behave, and the DCA still manages to beat God
Yes.
because if an investor who knows where every single lowest point will be between
Mm-hmm.
two all-time highs, systematically uh, accumulates the money to invest in these lows between two all-time highs, right? He will still underperform someone who simply DCAs every month, low or high market, that just keeps buying every month. And that's why DCA beats God, beats an investor that just knows everything. So when you own assets that are good, you should just keep buying.
Yes.
It's not because it's up 200% that you say now, okay, stop, I'm not buying anymore, I will sell, and then you sell your winners. It's really important to take care of your winners too. Take care of the seller, of the losers, if they lose money because of market turbulence, just like UNH, which is your biggest position actually, or like for me, Humana, one of the biggest, and I know that we both just bought more of each of the stocks this week, despite being the losers of our portfolio, among the losers. It's because they are fantastic companies and they are down because of um, market turbulence. But the same applies to the winners. You shouldn't sell them just because they went up to 100%. If the fundamentals also improved 3 times better,
Mm-hmm.
right? So the stock price is justified. I'm not saying Nvidia at this price is justified. I don't think it's expensive, to be
I
honest.
justified.
It even became a bit cheaper
Mm-hmm.
than a year ago, right?
Yeah.
But it's still an expensive stock, and I would have bought it last year rather than this year, you know.
I bought it last year. Not last year. I bought it the year before. And I didn't buy anything. And I didn't buy any more since. So that's why I'm comfortable taking the volatility. The sideways and the volatility goes down 5, 6, 7% in a day because I'm sitting on 275% unrealized gains.
I will share the screen just so
Yeah.
so so we have the data in front of us.
Yeah.
So this one,
Right there.
Nvidia, right? You're up crazy amount actually, more than three
Yes.
times, huh?
Yeah.
You bought it at
That's not 3 times. That's
239.
4 times. That's 4 times.
That's practically 4 times. That's more than 3 times.
More
Insane.
than 3 times. 200% 3 times.
Yeah. And you actually kept buying over the months. You didn't buy all at once. You didn't wait for a low. You just kept buying.
Yes.
Oop. Yeah. You actually bought the dip here even. So you initiated first
Mm-hmm.
position 10th of January at the price of
Mm-hmm.
260, which is
Mm-hmm.
extremely cheap now, right? But when it hit $160, most
Mm-hmm.
investors would have sold it, would have panicked and just would have given up. But what you did was, "Hey, you must be crazy. You bought more of the loser." You bought it it was $100 cheaper than when you initiated the
Yeah.
position, and you bought more.
Yeah.
Why? June 2022. How could you guess that it would just go
Okay.
up after that?
Listen, I didn't guess it was going to be the bottom. Let's not, I don't want to just sit here and lie to you and tell you that I knew what was going to happen. I
No, but
didn't.
it takes guts to buy it
It takes a lot
after
of
it
guts. Yeah.
crushed. It
And I
crushed
have guts.
practically 50% from the
Yes.
position when you initiated it.
Yes. But, and, and you can't justify it. I mean, if my portfolio was down 50% at the time, would you have bought more Nvidia? I don't think so. I don't think so. But it was early 2022. No, when was it? No, that was in June. That was in June of 2022 when I bought at 162. I was down. It was a bear market, but I wasn't down like a lot. I was around the same level with the S&P. And the thing that you just said, DCA, you have to buy and keep buying. The thing with that's good. That sounds good in theory. What people do is when the stock is at all-time high, they're not buying. And when the stock is below the 52-week low or 50% down or 70% down, they're not buying. They're just waiting for the time, so it's not going to be as risky, even though it's less risky to buy it when it's low rather than high. Okay? So you're not DCA like that. You have to do it every month, no matter what, all-time highs, all-time lows, pandemic, whatever the case may be. Because during of March of 2020, when you were wondering if we all dying, I don't think you throw money into the stock market. I'm talking prior of the Fed put, before the Fed got into the picture, when it was a day that the stock market went down 10%. Amazon went down 12% in a single day. Are you jumping in the following day? Maybe you are. I mean, I don't know. I mean, if you see, go find JPM. Right
This
there.
one here, yeah.
Scroll the way down.
That's
13.
everything.
Well,
So you started buying in 2020,
yes,
mid 2020, and you continued all the way till end of last
that's
year.
my first position right there. When I started on eToro almost 4 years ago, $97. That's my very first position. I haven't told it yet. It's right there in front of you.
Yeah.
So when I say I'm a long-term investor, I'm a long-term investor. You can see right there.
No, absolutely. You know, most people who would buy it at 100, they would have exited already at probably 20 or 30% profit. But then look, current price is double from when you started.
Yeah.
But you just kept buying.
Yeah, I
You just
kept
kept
buying because
buying.
it's a really good company.
And you increased the average price,
I
right? You
did, yeah.
increased the average price. Most people are very allergic to that, increasing the average price. But in absolute, you
Yeah.
increase the profit. And
Yeah.
this is what matters. Too many people are anchored to certain figures from the past, right? Saying, oh, but at 100, I'm set to buy at 200. Yeah, but if it's twice more profitable, right? Or three times more profitable, it makes sense to just keep buying.
Yeah.
You shouldn't be anchored to
And
your first position.
and you can't, I mean, how many positions are there? 2, 4, 6, 8
A
positions?
lot of them.
So
Yes,
8
eight
positions.
positions.
So you can't call it exactly DCA because I bought 8 times in almost 4 years. So you can't really call it dollar cost averaging. But I can tell you that a couple of times I bought it when the day after earnings, when they missed earnings and the stock went down 3-4%, and I jumped into that. I mean, there's no other way to get them cheap. You have to buy them when something is going on. That's the secret of this whole thing. I think investing comes down to two things. Can you buy when everyone is selling? Like 2 days ago, you and I were chatting and we're talking about healthcare. And it just happened. We hung up the phone, the market opens, healthcare sector takes a dive. I'm texting you, I'm telling you, I'm buying UNH. You told me I bought Humana, okay? So you bought it the same day I bought something from the same sector. You didn't buy it when it was all-time high. You know what I mean? So it comes down to that. And then the second thing is, do you have any available cash to buy when everybody's selling? Or do you have to sell other positions that they're just getting there to buy something that you want to buy? So if you manage to do these two things, you're in a good shape. And then another thing, just don't panic. When something happens, just don't panic.
It's important to not panic. It's important to have some cash on the side, but not too much cash.
Not too
Because
much.
if you have too much cash, I mean, the cash itself will lose value over time.
Yes.
So that cash, you could park it potentially in treasuries, right? Have an 80-20. I'm not really a fan of a 60-40. I think 60-40 is way too concentrated in treasuries.
Yes.
I'm a big fan of 80-20. And 20% to have it in parked in treasuries. And that way you could sell the treasuries, or ideally the treasuries, they should have different maturities over time, right? Like every 3 months,
Yeah.
one bond will be paid back by the government. So you get that cash and then you can reinvest it in the stock. And that way, every cash that you get from your salary, you put it directly in treasuries this month. And then every time there is a bond reaching maturity and you receive the repayment with the interest, you take that money, you put it in stocks. And that way you can keep a balanced 80-20 portfolio, and at the same time keep growing the money that you have invested in stocks. Unfortunately, Tor is not great for treasuries. So I do that on another platform. I have US treasuries and some other treasuries that pay interest, and some with short term, some with medium term maturities. And when I get the money back from them, I go deposit in eToro and I buy stocks with that. And I think it's really important that you have a portion, maybe 20% of your wealth, that is liquid enough to be invested in stocks when a crash happens.
Yes.
Just to invest regularly, but when there's a crash, if you can, you put a bit more money.
Yes. I
And,
think
and yeah,
I,
go ahead.
I agree with you with the latter part. The first part about treasuries, and that's my opinion, that's my style, my risk appetite, is I'm still young to be invested in treasuries and sacrifice potential returns just to be in treasuries. Maybe 10% I can justify it, but I think I'm, I'm older than you, and your investing time horizon is much longer than mine. Uh, but for me, when I get well into my 40s, then I'm gonna start.
Yeah. But
Yeah,
what do you do if there's, I mean, there will be a market crash
yeah,
in the next years. We don't know when, but
yeah,
there's always been.
yeah.
Where do you take that cash from? If you have only 10%, it means you're going to be able to only invest this 10% during that crash. Where do you have your cash parked? Oh, you don't have any cash, you have
I do
10%
have cash.
treasuries?
I do have cash that I can put them into the markets immediately. It's not just the cash I have on my account. I have other available cash that's sitting on a saves account, and they don't get anything. And in case something happens, which I did, by the way, in 2022. In 2022, I didn't sell a single position. I didn't sell a single stock. You can go back on, you can go
Mhm.
and, I mean, how could you talk to my copyrights? Because they know, because they can
Yeah.
see my each move I do. I didn't sell a single stock in 2022. I was only buying, and I was buying, and I was buying, and that was the reason I was down 23% during the bear market, and I was 40% the year after.
Mm.
So I recover my unrealized losses. It wasn't
Mhm.
realized. I was
Yeah,
just down.
just
And
on
then,
paper. Mhm.
yeah, and then I made that and then some. So I
Yeah,
came back stronger than I went into.
yeah.
So yeah,
I remember that actually because during our eToro event in
yeah,
Abu Dhabi, you were giving a presentation,
yeah.
right? I remember asking you some questions there, perhaps a bit aggressive about some of your strategy. But I do remember that you said that you never sell. You try to, not that you never sell per se if the fundamentals change, you sell, but
Yeah.
you never sell just to take a profit. You try to keep all the assets you have, and you keep buying over time. And if the prices are cheaper, you buy even more.
Buy even more, yeah. And
Yeah.
it's simple as that. Because um, So the more selling, so the more buying and selling you do, you're paying they're paying the fees, the spreads, and all that. And you're trying to pick the timing. Most of the time, you say, okay, Nvidia is not going
Yeah.
to pick it up. Which, by the way, in some time in the future, if Nvidia keeps going how it's going, I'm going to have to sell some, not a lot of it, just to rebalance it. I don't want it to be 12% of my portfolio, and then something happens and it goes down 20% in a week, which
Mm.
we both know it could happen. It could
Yes. And
happen.
yes.
So for rebalancing purposes, I can sell and I can buy and I can do whatever. But just for the sake of selling or for the sake of buying, that's not how I operate.
Mm.
And you know what? So far in the last 4 years, it's been working.
Mhm.
It's been working, and maybe something wrong with me that during the 2022 when during the bear market I was buying when at a time that people were not buying. Everybody was scared to risk money into the market, and I was
Yeah.
buying and I wasn't selling, and it worked out.
Yeah. I don't remember who said, but investing is the art of catching falling knives, right?
I read it yesterday when who said that? I think it was Howard Marks. Howard Marks.
Ah, yes, I think so.
Yes.
Yes, yes,
Oh,
yes, yes.
he's
And
brilliant. I,
this is,
I, re- I read the book, The Most Important Thing.
yeah.
Have you read the book?
I actually have it on my shelf, and I'm going to start reading it.
Amazing read. But go
I
ahead.
just ordered it. Yeah.
So go ahead. You were saying?
Yeah. So I think the problem, though, if I may,
Yeah.
I don't want to be just all positive, but
Hmm.
you have only 56 copiers. In
Yes.
my opinion, you should have hundreds, maybe thousands, because I would copy you if I was an also popular investor. I would copy
Yeah.
you based on the strategy that I know from you because you did that presentation in Abu
Yeah.
Dhabi, and we talked many times since then.
Hmm.
And I know your strategy, and I know it makes sense, and I know that you understood pretty much everything that a good investor needs to know. I'm not saying you know everything, but you know really everything that an investor should know in order
Hmm.
to succeed in the market. That means
Hmm.
to be diversified. Doesn't matter if you have 20 or 50 assets, but to be diversified, to keep buying, even when, the markets go down,
Hmm.
to not be overconfident about one asset that you have, right? So to
Hmm.
always keep a balanced portfolio, to not have too much cash, but to
Hmm.
also not have too little cash. So
Hmm.
for me, those are the pillars of success, all those.
Yeah.
And there are differences between my strategy and your strategy, but we apply those pillars.
Hmm.
And in my opinion, if it's communicated better, or perhaps if there's more, I think the problem is that a lot of people don't actually read. Uh,
Yeah.
they see the stats and they're like, all right, this PI is up
Yeah.
uh, 300% this year. I'm gonna copy. Sorry, Akim, I'm leaving you.
Hmm.
You're up only 15% every year, but I'm going with that guy. He's up 300% last year.
Yeah.
Yeah, but the year before he was down 80%.
Yes.
The problem is that minus 80% and then plus 300%, it's not plus 220.
No, it's not. No, it's not.
You haven't even recouped your losses.
Yes.
That's the
Yes.
thing.
Absolutely.
If you're down minus 80, I think you do need to do plus 400%.
400%. Yeah. Just to break even.
So you can be up even 300%,
Yeah.
which is almost impossible to achieve, even if you're fully in Bitcoin on a good year.
Yes.
You're still not recouping your losses, and you're likely to lose again 50% at least of your value the year after.
Yes.
And I think that is the fundamental problem with you and me as well, because I also don't have many copiers, in my opinion,
Hmm. You
compared
have
to the
more than
strategy
me.
you have.
You have more
Yeah,
than me.
yeah, but it's not a big difference. When I see some copiers that have thousands of copiers, right?
Hmm.
I have about 150. You have about 50, but
Hmm.
it's almost the same amount of copiers. We both champion. We both have similar assets under management
Hmm.
or assets under copy. But some PIs have a lot more, have thousands of copiers just because they shine with
Hmm.
some return, and people don't take the time to actually understand what the numbers mean, but also what the strategy is of a specific PI. And I think we really have to do a lot of pedagogy. It's a bit difficult really to explain to the guys that having 15% every year return, right? 15% actually beats someone who has plus minus 80 and then plus 300 and
Yes,
then minus
absolutely.
50 and then again plus 100%.
Yeah,
Right? And I think this is why a lot of people they lose all their savings because they go all in on one asset or on one investor who was up 300%.
I
And
agree with you.
I think this is the fundamental problem. And the worst is that they actually tend to copy once that investor or that asset already did the 300%.
Yes, and then it's on the way, and then it's on the way down.
And then it's on the way down, and then they panic, and then they sell everything.
Yeah,
And when you want to enter the market, it's really important that you enter with the right expectations.
yes,
That the average historical return is around, I think, 8 or 10% for the
yeah.
US stock market, somewhere around that,
It's
around 8.
9.8. It's 9.8 for the S&P.
How much?
9.8.
9.8. So it's somewhere around 9 to 10% per
Mm-hmm.
year.
Yeah,
The best investors, they are not able to exceed those 9.8. There are very few investors able to outperform 9.8% over a long period of time. And even when they outperform, they don't outperform by much.
yeah,
And the thing is, when you see an asset or when you see an investor or when you see a portfolio that you want to copy, if it was up 80% and then up again 30% and then up again, let's say 50% last 3 years, it
mm-hmm.
is likely, it is more than likely that it will return to the mean of
Yes,
9.8% or even lower at some point in the years to come. And that is why it is important to uh, follow, listen, perhaps copy reasonable investors that have as expectation, let's say 10% per year. I mean, that
yeah,
they don't necessarily have that official target, but where you can see that there are not too big fluctuations around
yeah.
that 10% average.
And the
So,
thing is, so I understand what you're saying, and I appreciate your vote of confidence. But you and I had many conversations in Abu Dhabi. We had many conversations when
yeah.
we were doing the presentation, so we know each other. So, and by the way, that's the reason we do this right now, so we can put this conversation online and people can hear us talking about our strategies. But it's difficult for someone that doesn't follow the markets, doesn't follow the news. He doesn't read my posts when I'm writing about the Fed or about energy or about healthcare or about all that. They
Mm.
just scroll down, they see your stats. Oh, okay. No, I want someone that makes 70% a year. What am I going
Yeah.
to tell you? Okay. So you know me, I know you. We have talked for endless hours over drinks and over food and walking around in Abu Dhabi. And so we talked the other day, we text each other, so we understand each other. Now you have to get someone that is not into the whole investing thing like we are, that they understand how the whole thing works and what happens. And
Yeah. But you know what's going to happen is you and me, we will both have track record of more than 5 years.
mhm,
Actually, next year, I think we'll have already more than 5 years.
mhm,
Let's say we have even a 10-year track record.
yeah,
And those other PIs that had 200% and then 50% performance, we will see when we zoom out over 10 years that they will have a lot more red years
mhm,
and much worse performance
yeah,
than the good years. And you and me will have on average probably around that 10% historical performance.
mhm,
And compounded, we will have outperformed, we both turtles, we will have outperformed those rabbits that, are hopping very high, but then
yeah,
will fall really low. And it's really important. It's not about, promoting myself or promoting you. It's really I want people to understand that you have to always keep in mind the average return you can get from the stock market,
Mhm,
and that you have to be reasonable with your expectations.
mhm.
Okay, you enter stock market, you say, I want 100%, but it's not a restaurant. It's not a restaurant where there's a menu and then you pick and then you
And then
get
you
that
pick, yeah.
order. Yeah. Eventually you will get it, but then you will get the invoice
Yeah.
at the end.
You're
And
gonna get the
I can
bill,
tell
yeah.
you, I can
You're gonna
tell
get the
you,
bill.
you're gonna get a very expensive bill in the end. And that's why it's more, you have to be reasonable and you have to
Mhm,
have reasonable expectations. To invest in quality stocks, I would say don't go in those penny stocks.
mhm.
You can have for diversification purpose, maybe
Yeah.
5% of your portfolio allocated to uh, penny stocks, to
Mhm,
stocks that are worth less than $1 per share.
mhm.
Maybe there will be the next big thing in one of them, but it's quite unlikely
It's quite
because to
unlikely,
be
yeah.
because to be honest, those penny stocks that are listed in the stock market, they've been listed already as companies that are not very profitable. So it's
Mhm.
unlikely now that the owners have sold most of their shares that they will create something big.
Yes.
It is more likely that those owners, those founders, will open up a new startup and they use that next big thing that they had in mind in that new startup and then sell it eventually to private equity funds
Mhm,
rather than to that company that is already listed and where the management doesn't have many shares anyway anymore.
mhm.
And that's why it's really important when you're in stock market. Okay, you can invest in some penny stocks, just in case. But that's a waste of, in my opinion, it's a waste of resources. The companies that outperform are the value ones, the value stocks that
Mhm.
have good financials and that you keep for a big number of years. And I would say US companies, because US companies, they have this culture uh, of where they take care of their shareholders. It's not something you really have in Europe at the
No,
moment.
we don't have that in Europe. We don't have
Because
that
a
in.
lot of European investors, they anyway don't depend on the stock market to have their retirement. We discussed it 2 days ago. While US households, they completely depend on the performance of the stock market
Mhm.
for their retirement, for when they retire and for how they retire.
Yeah.
And I think this is where our advantages, European residents, you and me are, is our advantages there is that we can invest in the US stock market where really hundreds of millions of people play their lives with. The entire lives depend really on the performance of the US stock market. While in Europe, most European investors, their lives don't depend on the performance of
Yes.
European stock markets, really. And I think that's why it's important to be invested in the US when you're a European investor.
Yeah, Europe doesn't have the investing culture that the US has when it comes to the stock market. The
Yeah.
same, the same with Asia. China and Japan and Korea, they might have some good companies, but they don't
Mhm.
have the investing culture. People investing in the stock market, people getting paid twice a month, automatically they contribute to the 401ks. They don't do that. Is the stock market, the financial services in Asia and in Europe is not as large of a
Yeah.
percentage of the GDP as it is in the United States. I believe it's 20% of the GDP, financial services in the United States.
Mhm.
So it's a big sector of the
Yeah, yeah,
economy.
yeah, yeah, yeah. And you have all these management teams of all these companies that
Yeah,
buy the share backs, right?
yeah,
They keep doing those share buybacks
yeah.
in the US. It's not something you hear a lot really in Europe.
No, we
It's
don't
not
hear that
something
in
you hear a
Europe.
lot.
And it's one of the reasons why I'm completely invested with one exception, LVMH. Everything else is in the United States, and it's where I feel comfortable being invested. And
Mm.
and I agree with you.
Well,
That's
why LVMH actually? I mean, why would you invest in that stock? I think ask you. I didn't ask you actually last time. We didn't focus much on that.
you are invested in LVMH as well, correct?
Yes, but I want to know why you are investing because I do have some European stocks for diversification purposes.
Yeah,
I don't remember. I think last time I counted, must have like 5 stocks from
yeah,
50.
5, 7 stocks, something like that. Yeah,
Yeah, something like that.
it's a small
10.
percentage of your portfolio being invested in Europe.
Yeah, yeah, yeah. And some of them that are listed in Europe,
Mhm.
they're not exactly European stocks. When you take Mercedes, for example, yes, it's a German manufacturer, but they have the stock market culture because I mean, you have a lot of US investors invested in
Yes,
Mercedes.
yes.
They make a big source of their revenue also in the US, et cetera, et cetera.
They have factories
Um,
across the world, so it's not just
yeah, yeah,
it's not
yeah,
Germany
yeah.
centric.
Yeah, yeah. So fine, it's listed. I think it's listed in Frankfurt in Germany,
Mhm.
but it's not per se just a German national stock like German
Yes,
Post, for example, right?
yes.
German Post. I mean, I have nothing against German Post. I just mentioned German Post. And so why you invested in LVMH? Because their main source of revenue, I think, now is in Asia, or at least their main growth
Yeah,
is in China.
it's in China. Yeah, now it is. It was in the US the last 5 years ago. The most revenue was coming from the US, I believe, as China's economy grows
Mm.
and more people get out of poverty and they go into the middle class. They
Yeah,
would like to buy more luxury
they need to
items.
show off a
They
little
want to show
bit to show their
off,
status, make the difference from.
and LVMH will be there to sell you the Louis Vuitton and the Gucci and all that, all those brands that they've been around since the 1800s. The same brands, okay,
Mhm.
the same brands. They've been around since the early 1900s, late 1800s, okay, and they will be around for another 200 years. The barriers, the barrier to entry into the luxury item as a company, like you can't just start a luxury company tomorrow and start selling handbags for $10,000. That's
Mm.
not how it works.
Yeah.
It took Louis Vuitton and Hermes and Prada like a century to reach those prices.
Mm.
So that's number one. That's the moat. That's the moat. Number two is what's the name of the CEO? The French
The French guy,
the French guy who
Bernard Arnault.
yes, yes. I didn't want to butcher it with my English, so you said it with your
No, I
French.
speak French, so
Yes,
I
I
can say
know.
it.
So
Bernard Arnault.
so that guy, that guy running the company and I believe he made it like a family business.
Yes.
It's
His
his,
daughter is top
yes,
executive. His son
yes.
also
And
managed
and
department,
he
etc.
owns a lot of it. That's another reason.
Yeah.
And
Oh, he has skin in the game. I mean, the whole family has skin in the game. So
yes,
that's a big reason to buy
yes.
it. That's one of the reasons that I bought it. But I will tell you my other two reasons.
Let me tell you a couple of more. A third reason was during the during the during 2020 during the pandemic, the beginning of the pandemic, the stock was going down, and he surprised everyone by cutting the dividend to half.
Hmm.
When you cut the dividend to half,
Okay.
investors are just panicking. They want to get out.
For
The-
me, it's a good sign. For me,
it is a good sign of a responsible management.
absolutely.
Yes.
Cutting dividend, a lot of people panic, but I
Yes.
don't want to see too high dividends because then the company is stuck and doesn't have the cash to reorient its business
Yes.
plan. And it's a bit like AT&T now.
Yes.
AT&T is
Yes.
completely stuck because they have I think is around 6% dividend yield, which is
Yeah.
insane actually for some. So half of their free cash flow, 50% of their free cash flow goes into distributing into distributions
Maybe it's
to
more.
the investors, and they're
Probably
not
more than
able
50.
to invest, to innovate, and they stuck because once they will announce that they should, in my opinion, they should cut by half at least their
Mhm.
dividend payments and use that quarter of free cash flow into new things. You
Yeah.
know, AT&T has to innovate itself. I see the ads, it's all the time the same from
Mhm.
years ago, and they're
Mhm.
quite lame, to be honest. But it's the main way now to generate at least the same amount of sales as they had in the past years. And what I want to see in AT&T is a dividend cut to
That's not gonna happen.
perhaps get in. And
That's
it's
not
not
gonna
going to
happen
happen
because
because once they do it, it's practically game over.
it's game over for them, yeah, if they cut the stock.
But
But
let's go back to
let's go
LVMH.
back to
So they
LVMH.
cut the dividends.
When that happened, they cut the dividend. Everybody saw that and panicked, and the stock went further down. The way I saw that was okay. The French guy, okay, he owns a lot of this. He owns the majority, not the majority of it, but he owns a lot of it,
Yeah,
okay.
yeah,
And I saw that as a responsible move from responsible managers, from
yeah.
responsible manager. So I like that.
Because he would get those dividends himself, huh? Just
Yeah,
to make it clear.
yeah. He
And
was
if he's
putting
cutting the
himself.
dividends, he's
Yeah,
basically cutting his own salary in a way,
yes,
right?
absolutely. So that played a role of it. And at the time when I bought it, uh, the financials looked solid. I don't have the numbers in front of me now, but I remember so it was a combination of reasons. Then I saw he opened a factory in Texas,
Mm,
and Trump was there with him one day. I saw a clip of them together on CNBC. So I said,
mm,
okay, he's connected with Trump, so he's not gonna get tariffs just in case Trump wants to retaliate to Europe, because Europe actually has some unfavorable uh, trades trade barriers for US companies. So I
mm,
guess, okay, I said he's well connected. So that was a minor reason, it wasn't the main reason, but
mm.
it was a
Yeah.
combination of reasons. And it's an actually a really good company.
I'm seeing the share percentage actually just now while we speak. You were right. It's around 50% owned directly or indirectly by
Yeah,
Bernard Arnault and his family.
yeah,
Half of the company. So if they cut the dividends, right, they receive those cuts themselves.
yeah. And he became the world's wealthiest man when last
Years
year.
later, yeah, last
Last
year.
year.
Mm,
Yeah, everybody else is the CEO of Tesla and CEO of Amazon and CEO. And this guy, he's been selling the
mm,
things that we've been selling for 120 years. He's been selling the same bags that Louis Vuitton sold
yeah.
50 years ago.
I will tell you my two reasons,
Go
two
ahead.
extra reasons. So I agree with the reasons that you stated,
Mhm.
but I have two extra reasons.
Yeah.
Uh, One, and it's not to sound too provocative, right?
Mhm.
But one is when I see these Louis Vuitton products
Yeah.
being sold, every time I hear a beep of a bag being sold for, I don't know, 2K,
Mhm.
I'm like, yes, more money to me. Uh, because I personally don't buy brands. I try to live how to
Mhm.
say, very simple, right?
Yeah.
Because the money that I save, I want to build it over time and to finance other things that, in my opinion, make more sense than showing off your social status or
Mhm.
whatever. Because to be honest, most people don't care. If you drive in a nice car, people will look at the car and they will be like, it's a nice car, but they will not look at you and be like, okay, this guy has a nice car, so this
Mhm.
guy is actually cool, I want to be like this guy. No, most people, when they see a nice car, they think, okay, it's a nice car, I want the same, right? But the problem is the driver who spent 1 million,
Mhm.
okay, we spend, let's say, 200K on that
Mhm.
car and is driving that car around. He has 200K less in the bank account, so you don't
Yeah.
know if he has any more money than that. But anyway, he has 200K less. He's driving that car, and he thinks that people would admire him or her, would admire and would want to copy. But um when you look, I don't know if it's the same for other people, but for me,
Mhm.
when I see a nice car, I'm like, it's a nice car, but I don't pay any attention to the driver. And mostly you cannot see the driver because
Yeah.
the windows are anyway, tainted. They darken and you cannot see through. And when people buy these bags, very expensive, I'm happy because
Mhm.
I know that there is a huge profit made on every single bag. The
Yes.
value add that you have is
Yeah.
enormous.
Enormous. Yes.
It doesn't cost that much to make a bag for the amount they're selling it for. It costs practically the same as for other manufacturers to produce, but Louis Vuitton, because of the branding, is able to sell at a higher price. And for me, that's one big reason why I own the stock is because the value add that they're able to get
Mhm.
is enormous, and that covers the costs
Yes.
that you need. And the thing is, you don't need a lot of advertisements when you have those luxury brands, because ads tend to make it feel actually, less luxury and make it
Yes.
more middle class if you would have it all
Mhm.
on TV the whole time, right?
Yeah.
And that's why the expenses are not that high as well to promote the brands because they're trying to look exclusive, to feel exclusive, right? So they
Yes.
don't need to reach out too much. So that's one reason. And the second reason is related to that, is why they have such a high value add on every product. It's because they're selling a feeling to,
Yes.
to the buyer. And for me, this is really a big reason to enter any company, is when a company is able to sell a feeling more
Mhm.
than the product, but to able to sell a feeling, that is something that not many companies are able to own, that ability to sell a feeling by selling their product.
Yes.
And this is really important, and it cannot be replaced, or it's very difficult to be replaced by other market participants.
Yes.
Having a Louis Vuitton is something special, right? When a lady has a Louis Vuitton bag,
Yeah.
it's because it's Louis Vuitton. It's not because the bag looks nice. It's because it's Louis Vuitton.
No, the bags
And
are nice. Don't get me wrong. The bags are nice.
they
They're
are right.
quality. They're quality. Okay, go ahead
They
and
are
let me
right. I mean, quality is good,
tell you my
but you
take.
have you have other bags that have
Yeah.
good quality as well, and they cost a fraction of that. Yeah. So it's not about the quality of the bags. The people are buying Louis Vuitton and buying those brands, Christian Dior, etc.
Yeah.
It's not for the quality, yeah, of the product. It's really about the feeling, perhaps exclusive feeling you get when
Mhm.
buying such products.
Okay, so let me tell you my take on Louis Vuitton. I bought two of them.
What products or
No,
stock?
Louis Vuitton bags.
Really?
Yes, not
Okay.
for me. They were gifts.
All right.
Okay, so I bought
Whoever
two.
received them probably was happy.
She was, but she also had like 10 more of them. It wasn't
Okay.
just so. First of all,
But did she like? What was her reaction?
oh, I'm so happy, but okay, yeah, I like the color. But she had more
All
of
right.
them. She was happy because of the move, because of the thought.
Mm.
You know what I mean? Like if you buying someone that can afford to buy themselves whatever you just bought them, it's the move, it's the thought that
But
counts.
this is exactly what I told you, right? Is that there's a feeling
It's a
included in
feeling,
the
yes,
product of Louis Vuitton, right? There's a
yes,
feeling in it.
yes.
Also, that is a feeling, not necessarily when you buy it for yourself, but when you buy for
You
another
buy for
one,
someone else.
you're
Yeah,
able to wrap that feeling in
yeah.
in that product. But if you bought your girlfriend, I don't know, an electricity voucher for 1 month,
Hmm.
she may not be very
You wouldn't be
happy,
happy.
right?
You wouldn't be happy.
You cannot really sell electricity
Yes,
for the feeling of it, right?
yes. I know what you're saying. But going back to the Louis Vuitton, first of all, in my opinion, they are very well made. They are manufactured in France. They are not made in China. They are not made in Taiwan. They are made in France or Spain. So they are made within the European Union. The labor cost in Europe, it's higher than Asia. So that's one reason why they're expensive. Second, they can last for a long time. I know people that they have Louis Vuitton bags that they watch after them and they can last for 5, 10, 20 years. If you look after them,
Yeah.
they can last for a lifetime.
And they can increase in value. You can resell them
Yes,
actually more
yes, they
expensive.
hold their value. If they were
And
holding their value, they wouldn't be as expensive. They couldn't sell them for that much.
and to go to the previous point, sorry to interrupt, but
No, go
producing
ahead.
in Europe, I think is really important point. because we see the problem in the Red Sea. The
Yeah.
ships are not coming from China anymore. I
No.
mean, they haven't really struggled to come now. They would
Yeah.
have to go all around Africa. And
Hmm.
when you're in the luxury business and you have new collections, it's really important to be really there in the market already while the trend is lasting, especially if you're in
Yes.
fashion. It's really
Yeah.
important that you're able to bring your product while it's trendy.
This is
If you have
that's
to
too much.
wait, if you have to wait 6 or 9 months for your shipment to arrive from
And the
China,
next trend
it's
comes in, and
impossible.
then yeah, it's impossible.
And then it's too late already. And actually, Rivian, I
Hmm.
know you invested in Rivian. I'm not a big fan of Rivian,
I
but
know. I know you're
Rivian,
not. I know you're not.
Rivian's focus is to produce in the US,
Hmm.
partly for that reason, not exactly for the trend itself, but
Hmm.
just to be directly there at the market. If there's supply chain disruptions,
Hmm.
Tesla will have big struggles because they
Hmm.
produce in China.
Hmm.
And Rivian's strategy is kind of to hope for those supply chain disruptions because
Hmm.
it would disrupt everybody except them.
Yes.
Rivian produce their cars. It's very expensive for them to produce one
Yeah.
single car. I think it was yesterday or today that they produced their car number 100,000,
Yes, I saw that. I
but
saw that
only
this morning.
only actually, only 100K cars produced after all these years. It's not much really, and it's very expensive to produce every car. It's not enough the production, but they have that huge advantage is that they are well implemented. I mean, their manufacturing is in the US
Hmm.
and is safe from any supply chain disruptions. And even if, for example, Tesla produced in China and there's no problem with China, is they receive their parts from other countries, you know?
Hmm.
And if that part is missing or there's delay on one single part for the whole car, it delays the entire production.
Yes.
And that's why Tesla actually the stock went down recently is because the deliveries have been a little bit disappointing, is they've been a bit slow also. I mean,
Hmm.
they have been a bit slow at producing and delivering, and part of it is the Red Sea issue also, where things need to ship through. The basic resources need to ship from Africa, from Europe, also to China, and the products need to ship back to Europe. And if you have to cross that Red Sea twice, it becomes impossible. Even if you want to do it, the cost of the insurance is just so high right now, and you're not even sure your shipment will make it past the pirates, you know? And that's why Louis Vuitton has that advantage, and Rivian has a huge advantage. In my opinion, if you have Rivian, is only because of that. I mean, Rivian is the only thing I see is that their production is in the US. I don't see any other advantage, and you can keep bringing some points because I know you probably have like 10 reasons already.
Yeah.
Uh, Only one can convince me is that they produce in the US.
Okay, let's go back to Louis Vuitton, then I'm gonna get back to Rivian after that. So
By the way, it's your worst performing position in your portfolio,
it
Rivian.
is, but it's only 1.6%, so it doesn't really make a difference.
Yeah, yeah.
I can be patient with it, you know what I mean? It's
Mhm,
not
mhm.
like I have 10% on it, then it's
Yeah, yeah.
so
I'm
let's go
being
back.
provocative on purpose.
No, no, it's okay. So have you ever gotten into a Louis Vuitton stuff? Louis
Yeah,
Vuitton,
yeah, yeah. I mean, we have Luxembourg is a small country,
yeah,
and a lot of people are a fan of that, and
yeah.
we have uh very. I mean, if you walk in, if you should come visit Luxembourg, I would show you a bit around.
Mm-hmm.
There's some really
High-end
very
stuff.
high brands because people love that here in Luxembourg City, in the city. So we do have a nice Louis Vuitton store there. It looks very shiny. It's nice. It's made really nicely from outside. Yeah.
You have to go there on the busy season. You have to go inside, sit on the couch, take with you your iPad or your laptop or your phone,
Mm,
and start scrolling the bags that people are buying in front of you,
mm.
okay, and see the prices. And after a point, you can't see the price. After 3 or 4 thousand, they just say you're gonna find out the price at the store that they
Yes.
only online. So go there and see how they sell them. They sell them like hotcakes.
Yeah, it's
Sell,
insane. I cannot believe. But
yes,
last time I walked by, there was a queue going out from the store
yes.
for people waiting to enter the store to do their shopping there.
Yeah.
It's insane the number of people that are actually wanting to buy
And most
a
people
bag and are able to
and most
wait. And
people shouldn't buy them anyway, because I mean, if you are
yeah,
if you're making a lot of money and you have some money to afford to spend on having few bags, that's fine. But a lot of people, they're just trying to enter like the more high-end items, and they shouldn't be buying them anyway. But this is what they create. They create the need for lower class people or middle class people to enter the luxury items. That's what they sell. They sell exclusivity. If you're a woman and you hold a Louis Vuitton bag, in the eyes
yeah,
of some people, you have money. If that's the case or not, it doesn't matter.
yeah.
As investors.
Yeah, it's more for that for herself that she feels like she's
Yeah,
part of she's not worse than others. And I think
yeah.
it's really important for a lot of
And
people to
there are a lot of people in this world that they are like that.
yeah. It's really important for a lot of people to not feel worse than others. But this exists also among investors, right? That we don't want to feel worse than other investors. This is a feeling that can exist. It shouldn't, in my opinion, because every investor should come up with his own strategy.
Yeah,
Sometimes he will underperform, sometimes he will outperform. Even if he underperforms most of the time, if you have a strategy and you have a performance in mind and a certain risk appetite, you should just stick with it and not compare yourself too much to other investors. And
yeah.
I think
Comparing is always, yeah,
as a consumer also you should behave like that. Like if I had to compare myself always to someone, I would be really having to buy Louis Vuitton bag, having to buy a
Mhm.
Tesla car, having to buy this and that. And those are not things that make me happy, but I would have to buy them to not feel worse than others. And the problem is that I will not have enough resources, so not enough time and money to pursue my own dreams that actually make me happy, you know?
Yeah.
So, but anyway, we're going, I think, too much into spirituality,
No, no,
but
no.
it is linked to
It is
being an
linked.
investor.
Yeah, because if you are not into that, then you walk into a Louis Vuitton store and you see that bag worth $4,000, and you see a lady buying two of them at the same time, you can't justify it in your head as a consumer. But as an investor, oh, I love it. You know what? Why don't you go in there and buy five of them? And the
For
French
sure.
guy, Francois, what's his name?
Bernard Arnault.
Yes, I won't pronounce his name because I'm going to
How
butcher
did
it and I
how
don't
did you
want
come
to.
up with Francois? Huh? Every French guy named Francois or what?
So I'm sure he's really happy with the whole situation of how the world views luxury items. And that's why you and I were both investors in LVMH. So let me go back to Rivian. So Rivian at the time, so I bought Rivian, so it went public in 2021, November of 2021.
At a huge loss, right? There was no revenue at the time of the IPO.
No, no,
There was practically no revenue at the time of the IPO. At the time of the IPO, I think that was in 2020, no? The IPO.
2021. It was November,
2021 already?
November of
Uh,
2021, yes,
Reviewing date. Yes, November 9, 2021. In
2021.
my head, 2 years there that
I remember it because
passed.
I was online when it went public.
So
And
let me see. So
it
you
was,
bought it. Maybe I can share my screen actually. It's easier if we
go
both
ahead.
have a screen support. Share screen. Here we go. Share screen. Okay. Do you see?
Yes,
Yes. So you bought it practically at the IPO. You bought
that
it
was
a
the following
month
month,
a month later.
a month later.
I think you wanted to be smarter than the others, right? To
Yes.
buy it a month after the
You're not
IPO.
buying the day of the IPO. That's that's dumb. You're not buying the
Yeah,
day of the IPO. You're
I
buying
agree.
after when the stock goes a bit down.
I agree.
I thought.
Yeah. But you kept buying. You kept
Yes,
buying and buying, and you bought
yes,
even at the beginning of this year,
yes.
February this year. You're not giving up.
No, I'm not giving up. And you know what? When we talk again next year, the stock
Yeah.
is going to be $120 a share. You're going to go into that you're gonna go into
Yeah.
again, and you're gonna see all those positions in the green, and you're gonna say,
Mm.
"Oh," but if it doesn't happen, it doesn't hurt me. You know what
Yeah.
I mean?
Yeah.
Because
It doesn't because it's your smallest position,
yeah, I mean, if you see,
portfolio value. Yeah.
I have Bank of America, and I have Walmart, and I have Goldman Sachs, and UNH, and ExxonMobil, and Amazon. It's
Mm.
not like I mean, I'm invested in non-profitable speculative companies.
Mm. Mm.
Not. I
Yeah.
just
Yeah.
I just pick
You
my
diversify a bit, right? Yeah. It's
yes.
it's 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 more like a diversification play or not, Rivian.
No, no. Now you're just being nice. Is you're just trying to be nice. No, it's not for diversifying because I have Tesla. So if I wanted some EVs, I would just stick with Tesla. But the whole thing, I mean, it went public in
I haven't
2021.
heard any argument for someone to buy Rivian today or
I'm not even going to
buying
try
it a year
to,
ago.
I'm not even going to try to give an argument for someone to buy Rivian because I don't want anybody losing money and then blaming me. Uh, because I can take a small bet, 1.5%.
Hmm.
Other people are going to take a 5-10% bet, and they're going to end up losing money. So if I'm going to,
You're sounding a bit like Warren Buffett when people asked him, "Why do you have Paramount?" and the Paramount stock. A journalist asked, "So what do you think of the Paramount stock that you have in the portfolio?" And he kept listing things that he doesn't like about the company, that there's not a good prospect, that the management team is really incapable of
yeah.
of improving. And then the journalist was surprised and asked, "Why are you keeping the stock?" And he just answered, laughing. He said, "Let's see what happens." And this is what you're telling me about Rivian. Let's see what
Yeah.
happens.
Yeah. I mean, I'm not going to try to say, I mean, especially that position. I have my reasons why I'm invested in it still. Okay.
Mhm.
But I'm not going to try to make the case because it's going to sound stupid because it's not a company that anybody that is listening to this should try to get into. It's way too risky for most people. Okay. We just made the case for LVMH. And
Yeah.
anybody with half a brain watching this will realize that we're making a case for a really good company selling a really good product with a really good management team
Mm.
that has a huge part of that owns huge part of the business in
Yeah.
an industry that is going to be around as long people have money and willing to spend on luxury items. That company is going to be around. So,
Yeah.
wait, what percentage of my portfolio is LVMH? Scroll up a little bit,
LVMH. Yeah.
right
Need to
there.
go up
So
a
it's
bit.
5%.
Sorry, where is it? Did I skip it?
Yes.
Oh, sorry.
Right
Here.
there.
Okay.
Okay, so 3.5%.
3.5%. Here's
3.5%.
1.5 for
Yeah.
Rivian. It's
One and a
your
half for the
smallest, really.
yeah. The next thing.
Yeah.
So the next thing
By
I'm
the
doing,
way, you're a bit
I'm
here,
gonna get.
passive investor here, or what? I see
You know
that
what
you
happened
have an
there?
ETF in S&P and ETF in the Nasdaq.
I will tell you what happened
Huh?
there. So
What
the
happened there?
S&P. So no, since we're talking, I'm gonna justify everything you ask me. I'm gonna try to justify it. So what happened
Yeah.
here
Mhm.
on the S&P from Vanguard
Mhm.
is at the time the market was down 10% within a couple of weeks. And I was looking for something to deploy some capital, but I didn't have any strong convictions about anything else at the
Mhm.
time. So that
Yeah.
was the best available.
Yeah. 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 Yeah.
So nothing
And
was
and
wasted.
so it's really the reason is because you're a bit allergic to cash. I mean, you didn't want to have too much cash, and at the time you didn't find a company to select, and you preferred to have a portion in the
Yeah,
index.
yeah,
And maybe if there is a new opportunity, maybe you will take off from that index and then
yeah.
deploy, right? To
Maybe I exit the index and I get into something else when time is right.
Mm.
But when you have some cash and you want to invest them, and the market is giving you a 10% discount,
Yeah,
why
you
not to
have to
take it?
take it.
Why not to take it?
Yeah.
You have to be rational in sometimes, and I mean, I wasn't expecting yesterday buying UNH or 2 days ago, and
Yeah.
you weren't either. But
Yeah.
something happened, we hung up the phone, and then after 2 hours, we text each other and said, okay, I'm buying Humana, you're buying UNH. And
Yeah.
some
You bought a lot of
I
UNH,
bought a lot of it, yeah.
a lot because you had them much smaller allocation.
Yeah.
So yeah,
Yeah.
here you can see huge portion here, 2nd of April. Yeah,
And my belief is if you see the opportunity, you have to go heavy. You have to bet heavy.
yeah.
If you
You
don't
went very
bet
heavy.
heavy, at least at least to have some at least to have some impact. Let's say you're
Mm,
right.
mm.
Let's say the whole thing turns around.
Mm.
If you end up being right, at least to have some impact on your portfolio.
Yeah.
Show me Humana. Where is Humana?
Let
Up
me
there.
see. So this is my portfolio now.
Yeah.
This is like the worst performing stock. Yes, is this one,
Yes.
Humana. And I added more. So January, March, January, April, 2nd
Right
of
there.
April, 1543. That was, I think, about 1 hour after our call. It was
After,
right
yeah.
after market opening.
Yeah.
About uh, I increased my position by 20%. So I have 5 positions instead of 4. I always try to invest more or less the same amount of money in each position.
Yeah.
But I was telling you actually, so I have 50, so now I have 49 assets because I have a petroleum stock, this one, the CPE. It's not listed anymore. It got bought by another company. So this week it was official,
Mm-hmm.
and the asset actually I thought it would still be available on eToro. I mean, not tradable, but at least visible. But it's not even there. It's Kalon Petroleum. Another company bought it, and I received the cash, so I have one asset less than
Mm-hmm.
we talked 2 days ago. But I told you 2 days ago that I'm reasoning really in terms of sectors.
Mm-hmm. Yeah.
I try to think in what part of the market cycle we are. We're obviously at a peak interest rate by the
Yes.
Fed, at least in my opinion. I don't think we will go higher, and I don't think we can go any higher because of the US federal debt
Mm-hmm.
that is spending just so much on interest and is not able to sustain it for longer. So the rates will have to go down. Inflation, for me, it's still not it's not granted that we will be under 2% for
Yeah, that's not granted.
for some time. I think we will cut the rates because now the rates didn't change since at least 6 months, but
Mm-hmm.
it's tighter now than 6 months ago because the inflation went down compared to 6 months ago or compared to a year ago, even. When inflation goes down, the real tightening goes up, even if the rate is unchanged. Yeah.
Mm-hmm.
And that's why I think they will have to cut rates because the inflation has declined, even though it's not under 2%, but they will have to cut rates. And that's the market position where we're in, and I'm thinking about which sectors will benefit the most from the current situation. So from the rate cuts, in my opinion, it's the tech stocks that will benefit the most because it's always the tech stocks that benefit the most. When I say tech, I include blockchain,
Mm-hmm.
I include even crypto. I don't have directly crypto, but I have, for example, this ETF block. I
Mm-hmm.
wrote an article about it. This ETF actually owns shares of, for example, MicroStrategy from CEO, what's his name? Michael Saylor, I think, no?
Michael Saylor, yeah.
The company has a lot of Bitcoins. This ETF holds also crypto miners, like Riot platforms and some other big crypto miners. So their revenue depend directly on the price of Bitcoin. So I'm having this ETF like block. I'm having even a crypto miner directly called HUT. It's the Canadian crypto miner. There are 3 big crypto miners listed. There's Riot.
Yeah.
Yes. So I have an exposure to crypto because I think it's the most sensitive to rate cuts, and I have
Interesting.
a Hut 8 Mining Corp,
Mm-hmm.
which mines bitcoins. So
Mm-hmm.
it's a Canadian company. They have huge facilities in Canada, but also in other countries like US, and they
Mm-hmm.
produce Bitcoin. So they need really a good access to the electricity grid. So it's really more of an infrastructure company,
Mm-hmm.
infrastructure slash tech. and they produce those Bitcoins and then they sell them to the market. And Bitcoin in principle is very sensitive to rate cuts, but it's also sensitive to halving events, right? And there's a halving in 15 days, I think, from now,
Yes.
2 weeks. There's a Bitcoin halving. And that's why I own a crypto mining company. It's one of the three biggest. There is Riot Platforms. This is really US. And then there's another one, also US, Marathon Digital Holdings. Those I don't want to hold directly because of a regulatory risk I see in the US that I don't see in Canada. So I prefer to own the Canadian asset. But through Block, I own those US mining companies as well. And then I have some other tech companies like Google and some other tech that I believe are sensitive to interest rates and the valuation will go up because of those rate cuts. The thing is, I think I'm not extremely smart and I'm not able to really know what specific company will be the one that will perform better. And that's why I prefer to reason in sectors and to pick a couple of stocks in that sector. So I have a huge allocation to tech in general. I did not have it last year. I did not have it 2 years ago as well. I have it since the start of this year because I think this is where now the market cycle, that's where we are positioned in the market cycle. And then my other sector that is huge is energy. And when I say energy, I also include defense stocks like LMT and RTX. They are not energy, but they depend on similar aspects. They depend actually on this geopolitical situation. As long as the geopolitical situation is um, tense, I mean, it's more than tense at the moment, but as long as it's tense or more than tense, it is likely that there will be pressures on energy prices to go up and also on defense expenses to also increase. Today, I think, is the 75-year anniversary of NATO. And just the Cameron, it's the foreign minister of UK. He said,
He was the prime minister.
yeah, he was the prime minister and he's now the foreign minister of the UK, current foreign minister. He said that all the members should spend at least 2% of their GDP in defense. And this is really where we're going. We're going into more expense into defense because of the situation in Ukraine and some other tensions around the world. And that's why my other big sector besides tech is actually defense slash energy. So I really resonate in sectors. And those are my two big sectors. So you can see that most stocks are around 1.5 to 2.5%. It's just I'm trying to be humble here because I don't know which stock will perform better. But I have a strong conviction, right? A lot of copiers they ask, oh, you have 50 assets. Shouldn't you have some strong convictions? I have extremely strong convictions that energy slash defense and tech will outperform this year and next year. So I have two very strong convictions for this year and for next year. And this is why, unfortunately, I have to do a lot of explanation on why I have 49 assets or 50 assets
It's a
that
question
yeah.
that I will have if you had 50 assets.
Mm. Yeah,
Because, and I'm not
it's
saying,
not evident. It's not
and I'm
evident.
not,
It's not clear. But I think it's due to the eToro layout as well. I mean, I love eToro and everything is great about eToro. Not everything, but I mean, there are of course problems, but it's the best platform in my opinion. Social
yeah,
trading platform by far is the best. But I think there's a little problem in the layout because uh, when you see the chart,
yeah.
look, I work as a portfolio manager with investment funds here in Luxembourg. So I'm a portfolio manager for a number of investment funds in a portfolio management team. So I work with other portfolio managers and we manage portfolios of those investment funds. And we have similar charts for those funds, but so of course we have the individual assets, but we have the sectors also that each fund, how much capital is allocated to
Which
to each sector, right? Like 20% technology, 15% pharma, 10%, etc. And then also we have another chart where we have the geographical allocation
geographical location, yeah,
based
of
on the
course.
revenue actually of each of the assets, right? Not where they have their headquarters or whatever. It's really based on the revenue that each company makes. Unfortunately, in on eToro, we don't have those charts. Look, we have this 80% stocks, 20% ETFs, but that doesn't say much. And then we have this risk allocation, doesn't say really much. It's the risk for every asset there, but it doesn't really say in what sector that I'm invested. Recently, they added this little green box, which helps a bit. It's saying your portfolio is high weight in energy, technology, and pharma sector, suggests a diverse investment strategy. Well, it doesn't say enough, in my opinion. We should have a chart that really shows the allocation and perhaps to show the allocation over time. And you would see that last year I was really industrials and dividends. 2 years ago, I was also very much industrials and dividends. Infrastructure and dividends. Infrastructure, industrials, and dividends. The ones that have really stable revenues. The one that you know that a year from now they will make that much revenue, and you're pretty certain about it. I still have some of them, like Verizon, for example. Verizon, you know how much revenue they will make even 5 years from now. It's very stable companies that, it's infrastructure companies. They're well established. They're not going to grow, but they're not going to decline much as well. And that's why the last 2 years I was really into utilities, infrastructure, industrials. And now I shifted because of the position we are now in the market cycle. And I went much more into tech and also energy and defense. And I will keep probably the same sector allocation for next year. And then maybe in 2 years, maybe we'll have to see, depending on the geopolitical scene, but probably I will go much more in tech, really pure tech. But this is still far away, and I will see the macroeconomic and the macro geopolitical situation at that time. And this is why I say that, I have 50 assets, but I really have a hard time to market that, but I'm going to stick with that big number of assets. Maybe I will reduce a little bit. I will cut some losers, but it's not really because I want specifically a small number of assets. It's really my way to resonate in sector. And it's also easier for me to reallocate, because if I have, for example, 10 assets in one sector, I can easily cut one or two and then take those one or two positions and add to tech, for example. So I would reduce one sector by 5% total allocation, increase the other sector by 5%. So it would make a big shift actually by just changing two assets from here and putting them in the other sector,
All right, so let me ask you this.
Yeah.
How many assets did you have in 2022 in your portfolio?
I always had a lot of assets, so I never
Okay.
I had I think I had around 30, and last year I probably had around 35 assets.
30, 30,
I
35,
don't,
and 50 is
yeah,
not the same thing.
no, but I don't really keep track on number of assets. It is true that last year there was a little bit it was a bit too how we say it. The fluctuation was a little bit too high, I didn't like that one month I could go down 5% and the other 6%, and then 1 month 4%, the other 10%, one month 12%. It was a little bit too volatile, so I prefer to have something more stable. For now, it's working because I don't want to see -5%. I also don't want to see plus 10 or 12%. I mean, it's welcome, of course, if they're plus 10 or plus 12%. But I want to be more careful, so I added more assets. Also, I'm not choosing randomly those assets.
I didn't
They,
say you. I didn't say you were.
yeah, yeah, yeah,
I'm just asking.
yeah,
Yeah.
yeah. But the assets that I choose, so once I know what sector allocation I want, I go in that sector and I screen hundreds or thousands of companies, and then I choose really based on the financial quality they have, and also on management. They need to have good management, and also on adverse media. So I make sure there are no negative news in the last couple of months or years about management, for example,
Mhm.
about misbehavior of someone. For example, uh, Tesla, there were some news about Elon Musk doing heavy drugs regularly. It's something that doesn't fit my risk appetite, even if the company is great, but it depends on one man who does heavy drugs. I mean, he's a
Allegedly,
genius and
allegedly,
everything, but it exceeds a bit my risk appetite.
yes.
Okay. And that's why I have 50 assets, but I don't have 50 sectors. There are 11 sectors there, and I have two sectors that are really core in my portfolio, and then the rest here and there
Okay,
spread a little bit.
okay. So let me ask you this:
Yes.
say someone put a gun in your head and said you only get to keep one position of your 50,
Oof.
and all your capital has to go into that one position. Which one is it?
For how long? For the rest of my life.
For the next 3 years.
For the next 3 years.
Yes, and you don't have too much time to think about it. You have 2 minutes.
I haven't talked about it because I really never really think in
And I'm
that
going to
way,
tell
to
you
be honest.
and I'm going to tell you where I'm going with this. So just take a look and say, okay, I bet my life that
Yeah.
position will be
Look,
around and I won't lose
for
too much money.
okay. Look, for the next 3 years,
Yeah.
if it's really for the next 3 years, not for my
Yes.
life, but for the next 3 years, I think it's a very easy choice. I would take my currently biggest position. It's
Yes.
TLT,
Guilty.
20-year Treasury bond ETF.
Hmm.
So it pays a dividend yield, but I don't care about the dividend yield, but it does pay a dividend yield. It's
When rates go down, this thing goes up.
when rates go
Yeah,
down, this thing goes up a lot.
goes up. They have the
And
inverse correlation with the
exactly, with the interest rates.
with the
And the
interest.
interest rates will not go higher from now. It was the first thing I told you when I
Mhm,
was showing my portfolio.
mhm.
Is I think that we're not gonna go lower in TLT, and we're likely to go higher in the
Yes.
next 2 years for sure, maybe in the next 3 years. And that's also why I mentioned that I will gradually shift more and more into tech based on that.
So
But
so
if I have
so
to have one position, TLT.
TLT. So the follow-up is why don't you have more more percentages of your portfolio in that single position? Because you know we are at the top rates and
Yeah.
you know they're gonna cut in some point this year. Maybe it's not June,
Mm,
maybe September, but they're gonna cut. And
mhm,
it's gonna go well into the 100, 120
mm.
conviction peak, which by
Yeah.
the way, the timing now, assuming that the rates don't go further up, and
Mm,
probably they won't,
mm, mm,
they're
mm.
probably in the next 2 years, they're going to be going down consistently by half a percentage a year, three
Yeah,
quarters of a percentage a year. So TLT could be very well be into 120. Can you put the chart up for
easily.
TLT?
Mm. Yeah.
Please put the chart up for TLT so I can see.
Sorry. Yes. Oops. Just open it directly here.
Yeah, put the chart and go further, go back.
There we go. I'm not sure here how to zoom. How to go back further actually here. I usually use only on my phone.
Yeah, me too. I'm not using that too much.
I'm
Uh,
not using on desktop.
in the top left,
For
it
the
says
day, maybe if I put
1D.
week.
Yeah. So one
Okay,
week.
here
No,
we
no.
go.
Have to go back
Fantastic.
5 years.
Fantastic.
No, that's
Fant-
what that's 1 week. Oh, there you go.
No, 2011, yeah.
2011. There you go.
Since
So you see?
2011. We're at the level of 2011, basically.
Yes.
After the whole, global financial crisis and everything,
Yes.
after the entire crash, where the rates were quite high.
Mm-hmm.
They were not high because of inflation, but they were high because of real risk of
Mm-hmm.
governments not being able to pay back
Yes.
their loans, and a lot of financial actors and lenders were scared to
Yeah.
actually finance governments that were failing.
Not
So
sure.
we're back to that time, really.
Yeah.
You look at TLT. Um,
2011 was the European Was the European crisis with Greece?
Absolutely,
That was
where we had more than 20 or 25% yield on Greek bonds.
yes.
Yeah. This was
So
insane. You're not Greek, no? You're somehow some Greek roots, no? You're fully from Cyprus, or
no, I'm from Cyprus. I speak Greek.
what was the situation in Cyprus? I think it was similar or not to Greece. I mean, it was better, right? But there were
No,
some
no, it's actually no,
some risks, no, in
was
Cyprus or not?
it was actually worse. 20,
Worse.
2013, uh,
Mm,
Cypriot banks got a haircut.
mm,
Are you familiar with the haircut?
not really.
So the haircut is if you have more money than what the government guaranteed at that point,
Yeah, you're forced to
you're forced to, I mean,
invest.
you weren't forced, they were taken from you. So I
Uh,
think it was forced. They didn't
mm,
have a choice. So if you have more than 100,000 euros in a single account on your name, any excess of 100,000 euros, it was taken from you to pay the debt, the sovereign debt that the government had at that time.
mm,
So in Greece, it was quite different the situation, but the problem was the same. It was debt.
mm, mhm,
And when you have debt and you don't have the money printer, you're not borrowing on your own currency, like the US has, that can just print the dollars,
mhm.
okay? And you're
Yeah.
borrowing in a currency that you don't control,
Mhm,
and you are accountable to risk like that.
mhm. But this is the risk. I mean, I think you told me why don't you put everything in TLT, or why don't you
I
put more in
didn't say
TLT?
put everything on DLT. I said why
Yes.
don't you put 4%
I
on
will put
DLT?
more on TLT. I will even perhaps go up to 10% maximum of portfolio value.
If you put 10% on TLT, I'm
Yeah.
gonna put 12% on UNH.
But you already have that level, huh? To
No, I
UNH,
have
practically like
no, I
8 or 9,
have
no?
eight and
Yeah.
a half, 9.
Yeah. Yeah. But TLT, look, has conviction,
Yes.
but I, as I said, I don't want to have too much on one asset. I don't have a too big conviction on one single asset.
Mhm,
But yes, TLT would be my highest conviction because it's likely will cut rates.
mhm.
But you don't know if there will be a financial crisis. Last year we had rumors of even Deutsche Bank potentially failing. You don't know if something might break in the system where perhaps bank will fail again, like they failed in 2008. I
Yes.
don't think it will be banks this time. If something fails, it might be the US government itself in its payment, because the US government cannot print dollars now during its fight with inflation, because they would have to pay dollars to pay back the lenders, but they cannot print those dollars to pay back the lenders. And at the same time, you have high rates. So what happens if inflation rebounds this year, goes again up to 10%? What if it stays above 5%, the inflation?
Mm,
What happens? The Fed perhaps will tighten more or cannot tighten more.
mhm,
Lenders will be afraid to give more money to the US. So
mhm,
it's an extreme scenario, but it's not that extreme. Maybe 3 years from now, we will speak about how US ended up bankrupt,
mhm.
or perhaps how the interest rates ended up being 5%,
Yes.
or ended up staying at 5%. What if the rate stays at this level for the next couple of years? Then all my performance will be essentially flat, if not negative, by investing a lot in TLT, by investing everything in
Talking
TLT.
about 4%, I'm not talking about to put 20% on TLT. I'm
Yeah,
talking about you have 2% now.
yeah,
It's your highest conviction peak.
yeah,
The chart looks that it's the bottom or near
yeah.
the bottom. The environment we are with
Mm.
with interest rates, we are
Yeah.
at the top of the hiking cycle.
Mhm,
Most likely, we're not hiking further. If we hike further, it's going to be another 0.25.
mhm.
Let's say 0.5%, the top. We're not doubling from where we are now. So your
Yeah.
downside isn't significant, but the potential upside is quite significant.
It is
So
quite significant. That's why, again,
yes.
it's my biggest position, but I'm quite risk averse, and I don't want to put more than the almost 3% allocated to it,
And you
cost
know what?
basis.
And I understand that. I understand what you're saying exactly.
Because of the risk, because I'm trying really to stay humble. I don't know if next year, what happens if next year we're still at the same rate level, or what happens if the rate go up a little bit because of what I said, lenders don't want to finance US government anymore, or there's been an election and then something happens and Trump starts a civil war, let's say, then I will have big big troubles by my investment in TLT. Up to 5% is fine, up to 10% even is fine, but I would not go over 10% even on my absolute highest conviction. So if we were a bit in which case would I really go to 10% is if we already elected the US president, so the election is done. Let's say Biden is again elected, and let's say Trump doesn't contest, let's say. And if inflation was continuing to decline, but the Fed didn't start cutting rates, right? Or perhaps they cut just one rate, then I would probably increase it to 10%. And guess what is going to happen at the end of this year? If they cut the rate in September, right? They cut once, like we
That's what
discussed,
I think is
maybe,
going to happen. It's September,
right?
I think we get the first
Yeah.
cut.
Then you have the election, if I'm not mistaken, is in November, right?
Yes.
So December would actually be absolutely perfect for me to increase my exposure to TLT for next year. So for me, it's a play for next year. It will be safer to do it in December after US election and after knowing more or less the dot plot of the Fed to invest more in TLT. Yes, the price will probably have gone up already a little bit, but not that much because I think there will not be many cuts in any case this year. And this TLT is inverse correlated to the interest rate of the Fed. And that's why I started with, it's already my biggest position now. We're just at the start of the year. I will keep adding cash to it, but I think I will really decide to go heavy at the end of this year. Probably December, I will be like, okay, let's put 10% of the portfolio for 2025. Let's put it on TLT.
Okay. You convinced me there. I have one more question for you. Do you get any pushback from your co-peers that you are invested in defense contractors?
No, really, the pushback I get is on the number of assets, because in their opinion is, a good investor should be one that picks 5 stocks and knows that those 5 stocks will do 200%. But there's no way of knowing that. You cannot know it.
No,
Even if you're a good investor,
that's
you
impossible to get
no.
it right. At
No,
least
and
consistently.
all the great investors that you see, they have a lot of assets as well.
Yeah.
They consistently have more than 15 or 20 assets. I think they say you should have 20, 25 assets approximately for good diversification, around 20, 25 at least.
My sweet spot is between 18 and 23, 24. That's the range I found that I can get some alpha and protect myself from the downside if something goes wrong. More
Yeah.
than 24, 25, I found that I'm losing my edge. And under 18, 17, it becomes too volatile.
Yeah.
It's something, if a
I
position
see.
or two goes trends the
Yeah.
wrong way.
Yeah. Just to add a little thing, you could tell me, why don't you invest in 11 ETFs, one for each sector, and then you just put more in one ETF. The problem is each ETF has 50 or 100 assets of that sector. And I think where I find the alpha, because you mentioned it, is when you resonate in sectors, but you're able to pick 3 or 4 very good stocks of that sector. And that is where I find the alpha in relation to having 11 ETFs, one of each sector. you
Mhm.
know. And this is for me the where I think I can find the alpha over the long term. I outperformed the first year. I underperformed the second year. This one, it's I underperformed the S&P. But if you take the S&P 493, so the one excluding the seven,
The
the,
Max 7.
the Mag 7, Magnificent 7, I actually outperformed.
Mhm.
That's what I keep in mind. And for now, I'm, let's say, underperforming. But again, outperforming the S&P 493 again. But that's because of NVIDIA, not so much the Mag 7. But NVIDIA has been up this year already, I think, more than 100%, right? Already this year. And for
Should
me,
be
it's a bit,
around, I think it was like 85% a few days
yeah,
ago.
yeah.
85%, yeah, year to date.
And for me, it's a bit too late now to include Max 7 and to include NVIDIA. Probably it was a mistake for me from last year not to having included it. But as I said, I'm thinking in terms of market cycle. And last year and the year before, what performed very well was infrastructure and industrials. This and dividend paying in general performed very well. I added a lot of tech, and next year I will go, I think, very heavy on tech and on TLT and less on industrials and infrastructure. But just because of I resonate really on market cycle. But I know you don't care about market cycles. Like you have your list of 18 to 23 stocks, and you just keep buying them, no matter the
No, my
market
list,
cycle, no matter the micro environment, you don't care about the geopolitical
I
situation,
do
you don't
care
care
the
about the US president, you
I
don't
do
care
care
about
about
that,
the
right?
macro. I'm a macro guy. I do care about macro. When you see me
Mm.
posting, I'm posting about the Fed and about elections and about
Yeah,
that.
yeah, yeah, yeah. You do post a lot about that, but
I do
in
post a
your
lot about
investment decisions, you don't care about them.
no, because you see, that was the post I did yesterday about United Healthcare.
Mm.
So, so the universe of the stocks that I'm willing to buy, it's so small because I want to know exactly everything about that small amount of companies. You know what I
Mm.
mean? I can't keep up with if I have a watch list of 200 stocks,
Mm.
then you have to follow 200 stocks of earnings and news and all that. But 25 stocks, I can follow
Mhm.
them all on LinkedIn. I can follow them on Instagram. I can
Mhm.
follow them on Twitter. I can read the news from Bloomberg and from CNBC with most of them. And when something happens, and I know it's not an individual company problem, but a market problem or the sector problem, then I
Mhm.
can jump in and buy heavy and wait for it to rebound and get a good
Mhm.
return.
Mhm. Mhm. Yeah, but yeah,
But
but the thing is, you're
that's a nice
anyway
picture.
never selling, no?
What?
I said anyway you are never selling. So why are you even following the news of the stocks you own? You're never selling them.
Because when I go,
Even
because
Rivian, you're not selling.
Rivian,
Not
I'm
to
not
come back to Rivian, but
Rivian, I'm not sell.
when will you exit ever a
If
stock?
Rivian, so if Rivian goes now is I believe $10 a share. If Rivian goes to $30 a share, which is highly unlikely in the next year or two, I'm gonna cut my position in half.
Yes, but what a stock needs to do for you to exit it? What does Louis Vuitton need to do to get rid of you as a shareholder? They cut dividends, not enough.
Not enough.
What does
The French
stock need to
guy,
do for you to
the French
exit?
guy has to leave.
Okay.
His son is gonna stay with his daughter or whatever.
Yeah.
They're not gonna be on top of management. They're not gonna be on top of the company, and something internal happens within the family, and they're losing control. That might lose me as a shareholder. If they start giving Louis Vuitton bags you buy one get one free,
Mm.
that might lose me as a shareholder. Do you imagine
But it
going?
might be too late already, actually,
What?
to exit. It might be too late.
Why?
Because the other investors would have exited already.
Yeah,
right?
but
And then you will be there sitting on your losses. And I think this is the main risk with you. I'm being provocative on purpose, but I
yeah,
think this is the main risk with with you as an investor, is that you keep buying,
yeah.
but it seems like you're never ready to just get rid of an asset. It's almost as if you're attached to them, like it's your
I'm not
babies.
I'm not attached to anything. The most difficult question to answer as an investor is when to sell a stock.
Mm. Yes.
When to buy, you can manage to say, you know what?
Yes.
It's down 50%, 60%, the management is good, all that is good. You can manage to buy.
Yes.
When to sell is the most
This
difficult question to answer as an investor.
I agree. And I think that one of the things, and then you can say, I think one of the things that helps you to sell
Hmm?
is to already know what you're going to buy with the
After,
proceeds of the sale. So
yes,
you need to already know what you're going to do with that cash. Because if you're just selling and then you sit on the cash, this is
comment.
terrible.
Yes.
When you decide to sell, you should already have a plan of what you're going to buy immediately. You
Hmm.
know, there must be a better opportunity to buy.
Yes.
Yeah. So in your case, why aren't you selling? Why aren't you selling any of those stocks? Because there are better opportunities out there,
I
probably,
mean, in my 4 years,
right?
I
Why don't
did
you go in TLT? Why don't you sell Rivian and buy TLT? TLT is going to perform better than Rivian in the next.
no, no, I don't think
No?
so. I don't think that would be the case. I'm open, by the way. I have it in my watch list, TLT. Okay, because
Mhm.
I know it's gonna help with my risk score.
Yes, but what about exiting assets? When? What the stock needs
I
to do to get
exited
rid of you?
General Mills like 2 months ago, a month ago.
Yeah, but why? What was the real reason
It
here
was
of
too
leaving?
it was too boring for me. It was boring.
Like what? Flat stock performance
Last stock
or
performance, yeah, it wasn't doing anything. It had a good reporting quarter, nothing happened. Then dependent on retailers, dependent on producers, it was like too many things depending on it.
when
And
did you sell it? Sorry.
it when
Yeah, yeah, when?
I believe it was like a couple of months ago, I sold it with a 1% loss.
Because
I
you know
bought,
it did it went almost 10% up in 1 month, the last month.
I don't care. Like I sold it, it's done.
Mm.
It's like you break up with your girl. You don't really care what happens after, no?
So you're having a hard time to break up, but once you
No
break
comment,
up,
no comment. Let me
once you break up, but once you break up, you don't look back, right? And this is the
no.
same with the stocks.
Yeah. Unless it's a company that you were forced to sell a portion because it got out of proportion within your portfolio. And then if it goes further down, and at the time you have cash available to buy and you're looking to buy that sector, then you can buy it back.
Mm,
But I'm not gonna buy. I'm not buying for the sake of buying, and I'm not selling for the sake of selling.
mm,
So I might go months without buying anything, and then I might go years without selling anything.
mm,
I'm I try to put the selling questions up to the future. Warren
mm.
Buffett said our favorite selling period, holding periods is
It's
forever.
forever.
It's
Mm,
forever. So if you make a decision to buy companies that you plan to hold for a really long time, then you're avoiding that question when
mm,
to sell.
mm,
Why and why should I sell?
mm. Yeah, yeah, yeah. No,
And
this is the difference, I think, between you and me. Another difference is you're holding the stocks forever, right? But
yeah.
I really think always in terms of sectors and market cycle, and I don't mind to sell my entire portfolio and remake a new one, but once per year maximum, because you know there are some expenses. I mean, you know, you may have some tax liabilities and
Hmm.
broker the broker spreads, etc.
Hmm.
So I prefer not to shuffle, but I think once a year it's okay to reshuffle. once a year. I think it's important to reshuffle, to question the assets you have,
Mhm.
and then change. In my opinion, maybe it was not true maybe 20, 30 or some decades ago, where you performed better if you just was holding to stock forever.
Yeah.
But I think at the moment, I think it's important to reshuffle, not too often, but I think there's an effort you need to do there.
So
Opinion.
do you
The
work
average stock holding is 6 months for the
yours?
for no for all the investors. The average holding time of an investor is 6 months at the moment.
Mine is 20,
20 what month?
20 months holding
Yeah.
period.
Yeah, but you started 20 months ago.
Oh,
No, you
well,
didn't start 20 months ago, but
no, I
it
started
means you,
I
yeah,
started
4 years ago, right?
almost 4 years ago. Yeah.
Yeah, and if you hold about 2 years, it means you reshuffled only once, basically,
I
your
didn't
portfolio.
shuffle. I only sold four stocks, five
Mm,
stocks. In the 4 years, I only bought and sold only
mm,
five stocks.
yeah,
Shake
but
Shack,
mm,
Dow Industrial, General Mills, Blackstone.
that's it. You have the
That's it.
four. Yes,
Maybe
but
one more
yeah,
that I can't remember now, but it's just five positions.
the average investor holds for 6 months
I'm not an
a
average
stock.
investor.
Yeah. And I think this is where we can have an edge over other investors is we don't hold for 1 month, 2 months, 6 months. Uh, in my case, I hold for about 1 year and then I reshuffle. It's true. But I reshuffle once a year.
Did you try to not reshuffle for 1 year and just do some minor reshuffling? Like instead of selling the whole thing, because in the beginning of
Mm.
the year, you sold off the whole
I
thing,
sold absolutely everything and remade
absolutely
a new
everything,
one.
and you
Yeah.
started heavy with bonds, right?
Yeah. So I have it in bonds and started deploying over the first quarter, deploying into shares.
Into bonds.
Yeah.
So did you try, because at the end of the year, you know that some assets they have to go, or maybe to lower your exposure to them and increase some to others. So instead of selling the whole thing and then trying to find opportunity after opportunity to
Mm.
get into each stocks, the way I do it is once every quarter I do a rebalancing. So
Okay.
I say, okay, Nvidia, okay, let's not get crazy here. I'm not going to let Nvidia be 12% of my portfolio. I'm comfortable between 6 and 8.
Mm.
Let me sell a little bit and let me buy something else so I can rebalance them. That's the
Mm.
way I do it. I don't, I
So
don't,
you do quarterly rebalancings then. It's not
yes,
like you just hold and you stay
no,
forever.
no, no. I do rebalancing, but it's
Okay.
not from selling, it's from buying mostly.
Mm,
It's from buying. So I said, okay, LVMH is number 6 in order. I would like it to be number 4. I would like it to be just a bit more. So I'm gonna buy some of that. Maybe it's not gonna be a rebalancing in 2 days. It's gonna be over like 3, 4 weeks. Try to get at least the pricing a little bit more favorable.
mm. But that sounds a bit subjective, huh? Your rebalancings. You're like, I want it to be number four instead of number six. Nvidia maybe to go down to number nine out of number
Be-
one.
Because
I
the way
mean,
I see it is like
that's
risk.
subjective.
It is subjective. Yeah, I'm not. In some things, I have my own way of doing things. And Nvidia, even though it's up almost 300%, I
Mm,
know that it can go down 20% within 3, 4 days.
mm,
So
yeah.
even though I don't mind taking risk, holding a position, my top position, more than 10%, I'm gonna sell a little bit and get it down into the top 3 or 4 and have United Healthcare number one.
Mm,
I mean,
yeah, 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 yeah. So you don't care about market cycle neither, because you don't mention it much. That you don't think that one of your stocks will perform better if the rates will be cut, which we expect
I do
to
care about
happen.
I do care about the market cycle, and
But in your rebalancing, do you take it into account or not?
of course I'm taking into account
Mm,
like healthcare.
mm.
healthcare is not performing well now because this is not the part of the market cycle that they perform well.
Yeah, correct.
But it's my so UNH, it's my winner from next year.
Hmm.
And I
Yeah,
bought it yesterday, and you as well.
yeah.
Tesla, and I'm not going to mention Rivian because I know you hate Rivian, but Tesla is not the part of the
I
market.
wrote an article about how you should
I
short
know, I
Rivian,
know. I read it and I probably liked it on LinkedIn. Okay. Even though I was holding the
even though
exact,
you're a shareholder.
yes, because you are a friend and it was like a really well done article. So,
So you like me more than Rivian. Thank you.
yes. So Tesla this is not the part of the market cycle that performs well at the top of the rates.
Yeah, for sure.
So that's probably the winner of next year as well.
For
So that
sure. Yeah.
so I take into consideration the market cycle. Of course I am,
Yeah. Yeah. Yeah.
but
Yeah.
I'm not as technical as you are with sectors and market cycle, and like you are
Mm-hmm.
more technical than me and you are more risk averse than me.
Yeah.
You are willing to get into more ETFs than me. So
Yeah. Yeah.
not
Yeah.
like,
Yeah. Yeah.
you know what
Yeah.
I mean?
Yeah. No, for sure. I think we have very compatible profiles because it's quite different. In my case, as you said, I'm less risk averse
Mhm.
and perhaps more focused on macro than specific companies compared to you. I'm
Yes.
not saying that you don't care about macro. You care a lot about macro,
Mhm.
about the big picture, but you seem to really enjoy following those companies,
Yeah.
to really listen about the specific companies on TV. For me, it doesn't make a big difference if someone mentions, for example, Humana on TV. I mean, it's 2% of my portfolio. I listen, but I don't care, right? But in your case, I think if you have 8% or 10% of your portfolio in one stock, I think you hear the name on TV, you
Yes.
automatically turn the sound on, tell your girlfriend, shut up. They're talking about UNH. I have 10% of my
That's what
wealth
you
in
have to
it.
do. That's what you have to do because
Yeah.
um, let's say one of my copiers comment on a post I do and said, what's wrong with UNH? And he's going to ask a legitimate question because 10%
Mhm.
of my portfolio and his position on me is on UNH. So I better know.
Yeah.
So I better know what's wrong with that company. And the other day, you and I were chatting and we were talking about healthcare. And then the market opened after like half an hour, and the sector went down. I bought, you bought,
Yeah, the
and
sector
that
crashed. We both bought.
yes,
I increased my sector exposure. You increased
my
your
position.
stock, your
Yes,
position exposure. I had the sector in mind. You had the stock in mind, but the action ended up being the same. We
and
both
it's the
added
same.
to our
And we
respective
both
stocks.
and we both expect that sector and those two companies to perform well towards the end of the year and next year.
Yeah,
So,
absolutely.
so you and I were not. So you and I were not very different.
Not very different, no. It's funny because we have different ways to think, but
Yeah,
at the same time also very similar.
yeah.
So it is quite interesting to be honest. Yeah, it's for sure. This for sure.
The time is
But
now.
the problem is UNH is not very bling bling. Not a lot of people know. You know, on eToro, there are a lot of European users. I think the main most users, 90% of users are European.
They know
Uh,
Tesla and they
they
know
don't know
Microsoft and Apple.
exactly.
Yeah,
They know Tesla, Nvidia, Apple, Microsoft.
yeah.
And that's why I didn't add Mac 7 to my portfolio, actually. It's not that I don't believe in them. I bought them for my wife's portfolio, personal portfolio. I did buy Apple, as I mentioned, and some others. Even for my mother, also, she has Nvidia exposure from 2 years ago, but I didn't add any because I wanted my portfolio to be a bit differentiated.
Yeah.
Because I feel that if I add Nvidia, Microsoft, Apple, if I have those, almost every popular investor has them already. And
Mm-hmm.
potential copier, they already have them. For a lot of them, they have the same Bitcoin, Nvidia, etc.
Mm-hmm.
And that's why, to my portfolio, my performance suffers a little bit from the lack of those super high beta assets like Nvidia, Tesla, Bitcoin that are really very volatile and other cryptos, right? But I don't include them because I want my portfolio to be differentiated so that I can offer a useful product to the eToro community, basically.
I think your portfolio is not lacking performance. I'm talking about this year because you had two good years prior. It's not lacking performance because you're lacking high beta positions. I believe if your positions were not 49 and they were 30, that win that you got from Raytheon and Lockheed Martin will have an impact on your portfolio, and you can get some action and some better performance with the same diversification.
Mhm.
But instead of 49, you will be 35 or 30.
Yeah.
That's my
I'm
opinion. You don't need
yeah.
you don't
Mm.
need to add NVIDIA in it
Yeah.
now. You must
Yeah.
be crazy to buy
It's too
NVIDIA now.
late. Also, Bitcoin to add it now, too late.
Yes.
And that's why I told you 2 days ago that I will reduce it to 40 probably during the course of the year. And
Mhm.
then I will have that, I think, 30, 35 target in mind,
Yeah.
if possible. Because again, I have to have enough assets for for each sector
Mhm.
uh, to be able to play my sector strategy.
Mhm.
But because in 2 years, for example, I think that tech will heavily outperform the rest in 2 years. It's a bit too early to say. I wait for confirmation, but I think it will heavily outperform in 2 years from now, 2026. I think in 2026, I will have maybe even just 15 or 10, 15 or 20 assets that will mostly be in tech, you know? And then some of them, I will still have a bit of energy, a bit of here and there for
Mhm.
diversification. But right now, because we're in that shifting period
Mhm.
where the market cycle is changing, the monetary policy of the Fed will be shifted. That's why I have a lot of assets right now. And because we're in that shift. And then I will have to imagine, how do we call those balloons in the air? Like you can how to say, like a vehicle in the air.
Yes. Yes.
Those hot air
What
balloons,
what they
right?
call?
Huh?
I can't remember what they're called.
Yeah, they have bags of sand, and you need to throw those bags of sands from time to time uh, in order to be able to direct it. I think it's called Montgolfier, actually, or hot air balloon. Hot air balloon. I just checked. You can call them hot air balloon, and it's those bags of sand that I have. I have 50 of them,
Mhm.
and I will throw them with time to stabilize, to have around 20 to 30 assets probably. 20, I think you need to be a bit really, you need to be brave and confident to have 20. I think you need to have at least 25. I think 30 is good.
I have 21, I believe, right? I have 21.
Yeah, but if you look at the really big PIs, they have a lot actually of assets. I mean, they have a lot more to lose than
Who
you
ha
and me for sure, right?
who has good performance and a lot of assets?
For example, I will share my screen again. We will promote two PIs here. What are PIs?
Who are we gonna promote?
Yeah, the CPH equities. I met him in
Yeah.
Abu Dhabi. He's a nice guy, Danish. 69 assets,
Yes.
69. And his performance is really good.
That was really good.
15,
Yeah.
30%.
15%, 31,
Yeah,
27.
and then bear market, but very high. We don't know what was his portfolio allocation before, but we know
Yes.
that this year, high performance, he has 69 assets, maximum 4%, Microsoft. And
Nvidia.
you
Yeah.
have a bit of everything,
Yeah.
really. You have a bit of everything. If you go very quickly, you have a bit of everything. And then the most copied PI, right, on eToro, the most copied one. I'm not trying to replicate their strategy. I have my own, right? Performance is also pretty good. Let's see, 58 assets
Yeah, it
actually,
does.
5% maximum in Taiwan Semiconductor,
Mhm.
TSM, that Warren Buffett also owns, by the way. He has a big,
Yes.
big share here in TSM. And those guys, right, they have more than 50, 58 assets. The other guy, I think I said he has 69. Very diverse. Somehow they managed to get really good performance. But again, they have a lot more to lose than you and me. And that's why it makes sense for them to have a super diversified portfolio where they don't risk much. promoting our common friend. This is a very good
Uh,
friend of yours and of mine. Excellent performance, and he's super concentrated,
Concentrated, yes.
extremely concentrated. 14
Yes.
assets. Most of his performance really.
25% in one company and 19 in another. Yeah.
You need to have really good guts, strong
He's
guts.
on he's
And
on
most
top.
of his performance is from here. It's from
Yes.
this 145%
Yeah,
in the
but
top asset.
he's way on top of his positions. He knows exactly what is going on with his positions. And
He
I'm sure
does only
I'm
14 companies. It's like Warren Buffett, right? Half of his portfolio in Apple.
Napo, yeah.
Mm.
And he's ready to sell or buy something else and readjust, I believe, in moments
Who?
notice.
Who?
Christoph.
Christoph?
Yeah.
Yeah, I mean, I don't know. He
I
always
see
had
him.
Oxy very high, really. He always had a quarter invested in that company, but
I
for
see
the
him
rest, I don't
posting
know.
about oil and about Oxy like very, very
Mm.
often. So he's on
Yeah,
top. I mean, that's the way to do it.
yeah. We have another guy who just became Black Star, right? Maybe you know him. He was not a Black
Yeah,
Star, he became Black Star because of his performance last year.
yeah.
Yeah,
Had a very good
six
luck.
assets.
How many? Six.
Six. Insane. Six assets. So those guys, it makes sense because they had everything to win and nothing to lose.
Yes.
But now that they have a lot of copiers, probably he will diversify more. But I think for the long term, it's important to be diversified
Hmm.
because if you're wrong for, oh look, I want to copy it 2 minutes ago. I think you need to be diversified
Yeah.
and over the long term if you want to succeed. It might work for a year or two, but to be successful over 10 years, I think you need to be very diversified. But look, he started also not really good, huh? So it's normal when you have very diversified portfolio to have some bad years, right? Not great, but those magical years is the ones that do everything.
Yes.
So you need a bit of luck, this for sure.
Mhm.
This for sure. Yeah.
So let's wrap this up.
Yes. I think your eyes are burning.
Yeah, they are because I have a light behind
It's
the
good.
laptop so I can look nice.
Yeah. I have the window. It's not very sunny, but there's enough light coming.
So it's been like 2.5 hours, and
Yeah, actually,
we could
I
go
honestly
for
didn't feel the time. I don't know for
me
you.
neither, me neither, and we could go for 2 more.